Hello guys, welcome to my channel Financial Concepts with Nirali. In my previous video, you have seen different types of mutual funds. So if you have not watched that video, then kindly watch it. Link is given in the description box. In this particular video, I am going to discuss different concepts of mutual funds which I feel is important for you to understand. So the very first concept is active funds. Now what is active funds? In active funds, the fund manager will actively manage the funds, which means he will continuously buy and sell the securities in order to gain profit. The cost of managing the funds is very high. Risk is very high, so return is also very high. As risk is very high, probability of getting loss is also very high. Next concept is passive funds. Passive funds is similar to index funds, which I have already discussed in my previous video. In passive funds, they track an index only. For example, if your index is giving positive returns, so you will also get positive returns. And if your index is giving negative returns, so you will get negative returns. Okay, so cost of managing passive fund is very low, risk is also low, and return is also very low. Next concept is NAV. NAV stands for Net Asset Value. For example, in equity share, so one share price is known as share price of a particular share. Similarly, in mutual fund, in equity it is known as share, in mutual fund it is known as units, and the price of a particular unit is known as NAV, Net Asset Value. Now, Net Asset Value is calculated by total assets minus current liabilities upon number of outstanding units. So this is the formula of calculating net asset value. Next concept is open-ended funds. In open-ended funds, you can enter and exit anytime. You can buy mutual fund unit or you can sell mutual fund unit anytime directly through AMC. AUM, that is asset under management. Asset under management means the capital employed, the capital of a particular fund or a particular scheme keeps on fluctuating as there are many buying and selling which takes place directly through AMC. Next type is closed-ended funds. In closed-ended funds, it is totally opposite of open-ended funds. In closed-ended funds, for example, there is NFO. NFO means new fund offer. It is similar to IPO. So when NFO comes of mutual funds, in mutual fund it is known as NFO, and in equity shares it is known as IPO. When new fund offer comes in mutual fund for a closed-ended scheme, there is a lock-in period like 2 years, 4 years, 5 years. At that time, investors cannot buy or sell mutual fund unit directly through AMC. But in closed-ended funds, you get the benefit of trading your mutual fund unit in stock exchange. You can buy or you can sell your mutual fund unit through investors, not with directly AMC, but through investors you can do buying and selling. So don't worry, liquidity in closed-ended fund is also very good, and in open-ended fund is also very good. Next concept is SIP. SIP stands for Systematic Investment Plan. In Systematic Investment Plan, what happens? An investor will invest a uniform amount, same amount every month on a particular day on a particular scheme is known as SIP. Now, what happens in SIP? If, for example, market is going on at a peak, market is at the peak. So your NAV is high, price of a particular mutual fund unit is very high. So the unit purchase is low. Okay. And when NAV is low, when market is at downtrend and NAV is low, so you will purchase more units out of that money. So what will happen? Your average NAV keeps on decreasing over a period of time. So it will benefit you when you are selling or redeeming your mutual fund units. Next concept is lump sum. Lump sum is similar to FD. Now what happens? In lump sum, you are investing minimum say 5,000 rupees on a particular scheme and market is at its peak. So what will happen? Eventually, the NAV keeps on reducing. For example, it keeps on reducing. So what will happen? You will think that you are suffering from loss. So lump sum amount is only suitable when market is at the downtrend. If in lump sum amount you are investing in at the peak, so you have to suffer from loss. So it is very important for the investors to have a good understanding about the market trend in order to invest in lump sum. If you don't have, then don't worry, you can invest in SIP. So these are various concepts which I felt which was important for you to understand. In my next video, I am going to discuss about advantages and disadvantages of mutual funds. So please like my video and subscribe my channel and please click on the bell icon so that you can get all the notification of my upcoming video. Thank you very much.